Economic Armageddon now requires a $782 billion repo bailout. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
Well, we're back sooner than I expected.
Yes, we are. Well, the crisis is, everyone knows there's a crisis now, and it's not just a public health crisis, it is a financial crisis. So we have seen some dramatic falls in the ASX 200. We saw some dramatic falls in the S&P 500. I mean, in the first half an hour or an hour of trading with the Australian stock market, we were already down 31.5%. Obviously, we've had a bit of a recovery, and we'll get to that in a second. But then when you look at the S&P 500, it's about a quarter, 25% down from where it was in terms of the peak. And we're only talking about in the space of about 3 weeks. So obviously, the share market is falling. Massive concern about the impact on the coronavirus, and obviously we're seeing travel bans, we're seeing basically economic activity grind to a halt, and that obviously has a huge impact on this debt bubble, because if you're not producing income, you can't pay these debts, and that's the catalyst to causing a loss of confidence and to causing the debt bubble to be a systemic crisis. And we always said that the debt was the quantum of debt, not just the quality of the debt, but the quantum of debt was too much, and that was going to cause the crisis. Now, even last week, the Deputy Governor of the RBA, Guy Debelle, was asked point blank at Senate estimates about the quantum of debt, and he still said, we're not nervous about the amount of debt. Now, the amount of debt is so critical to this crisis, and we're now seeing it, come into play. And in our last show, we talked about the repo market and how we went over 600 billion last week. And when we recorded the show earlier this week, it was at 641. Well, in the last 24 hours, we have flown past 700 billion, all the way up to 782. And so we're recording this on Friday night. I dare say that if not by tomorrow morning, Saturday morning, which is Friday afternoon, New York time, or getting into next week, we're going to fly by 800 billion, and we could easily next week be more than $1 trillion as to how much money has been pumped into this repo market to keep interest rates down, to ensure that this debt bubble doesn't blow up to smithereens.
Yeah, and a couple of points I want to make there. The first is, of course, the Fed is demonstrating its capacity to push really hard, right?
Yeah.
So they basically announced a huge number. The other point I want to make, though, is all of those movements in the stock markets, right? People aren't noticing what's happened to the bond markets, right? It's the bond markets that have gone really out of kilter. And that's where a lot of the problems are, right? Not only are a lot of the interest rates rising quite fast in areas where they don't normally, but there's now a disconnection between what's happening in the stock market and bond market, which is almost unheard of. And that's one of the reasons why we now have this liquidity crisis and why the central banks around the world are having to respond.
Yes, and on that liquidity crisis, I mean, what did we say in our last show? What did we say 3 weeks ago? The system is on life support. It's been on life support since the 17th of September, and they continue to pump more and more money into it, because if they stop, we will have the biggest depression in the history of the world. And again, I'm not sure whether when we talk about this in the studio, Martin, whether our audience fully comprehends what we're talking about. But I mean, we've spoken about this, the social costs. I mean, the social costs are so extreme, and we are on the precipice of such a cataclysmic breakdown of the market. And the fact that they are, the fact that we've basically injected an extra 100 billion within the space of a week. I mean, we're really, getting up to a dramatic pace of liquidity that they have to throw at this.
Yeah, and it's worth underscoring also, the European Central Bank also did stuff, as did Canada, right?
And the UK.
And guess what? The RBA did something as well.
Exactly. So important point to make in terms of what happened today was, I had a few emails and phone calls that said, what happened with the Australian stock market? It was down about 8%, and then it finished at about, was it 4% that it finished up? So about a 12% movement from down to up. Well, the RBA injected $8.8 billion today, according to the AFR. And why? According to the article, foreign hedge funds were dumping the Australian government bonds, and obviously once you sell bonds, this pushes the interest rates on the bonds up, and we can't have high interest rates because that means that the interest servicing costs get too great, and you're going to start seeing defaults. So out of nowhere, they've just thrown 8.8 billion, and we'll actually maybe put a tweet that I put up. We'll put up on the screen, because I actually asked the question, which is the most obvious question, which is something I've been railing about with you and others for a few years. Is, well, where did the money come from?
Yep. Well, there it was, appeared, right? And at the time that it was basically out there, by the way, the Reserve Bank on their website has no official notification of what they did, right?
And important on that, Martin, is when they did something similar in 2008, there was nothing on their website then either.
Correct. So we found it through the AFR, but once it was out in public land, and obviously it was on all the wires, that was when the market moved. Right? And so people responded in the market to that significant intervention from the RBA. Interestingly, though, if you look at the exchanges in Asia and in Europe, they're not going the same way. So essentially, my suspicion is that on Monday, we'll see it come back again.
Potentially so. So I think the Dow futures has the share market falling another 800-900 points tonight, as in Friday morning New York time. So we'll have to see what happens with the Americans in the next 12 hours. Yep. But just to sort of get back to what happened in the US markets overnight. So let's just put slide 1 on the screen. So basically, what we saw overnight was a dramatic explosion in these term repos. So there was 3 types of repos that were offered. There was a 14-day repo, which is a 2-week. There was a 1-month repo, and then there was a 3-month repo, and that's where all of this extra liquidity, comparing where we were early in the week at 641. And now we're at 782. Well, a lot of this came from these term repos that basically have been injected. Now, important on this, Martin, is that the New York Fed in the last 12 hours said that they were willing to inject $1.5 trillion into the repo market. Now, they said they were going to do this in 3 separate lots of $500 billion. So you and I had a phone conversation this morning. I said, I'm trying to find this money. I can't find it. So what actually happened is they offered a 3-month repurchasing agreement. Now, the market put in bids for only $78 billion. So just to be clear, even though the headline says $1.5 trillion, what happened today was the Fed said they were willing to offer today $500 billion. So the market put in bids of only $78 billion when they said they were willing to pay $500 billion. So there are some headlines, and there have been some people on YouTube, some American commentators, saying they've thrown $1.5 trillion at the market. Now, they haven't done that. All they've done so far is throw $78 billion, and they've only done the first tranche of this $1.5 trillion. Now, tonight, as in Friday night Australian time, they will proceed with the next tranche of this $1.5 trillion. So we will have to see in the next 12 hours as to how much additional money is required by the banks and the hedge funds. So it could be an extraordinary amount. It could be a small amount. So we just don't have to see. So I just want to be clear, because some people are going to look at this number of $782 billion and saying, well, but they announced $1.5 trillion. Well, no, they just offered half of that. They offered $500 billion, and the banks only said we only need $78 billion.
Yeah, and my view is they went for the 1.5 trillion simply to demonstrate in a muscular fashion what they could do if they needed to do it, right? So it was partly about confidence as well as just the number. And the other point I'd make is that a number of the market operators have alternatives at the moment because of where the bond markets have gone, because they can unwind positions there as well. So we need to watch this not just over the next 1 to 2 days, but I think the next couple of weeks, because a lot of those liquidities will come back to the fore over that period, in my view.
One of the key points of today's episode, Martin, is that our viewers and the Australian public at large cannot fall for the coronavirus. So the coronavirus is so just to recall, in December of 2018, I had a meeting with a federal parliamentarian, Liberal, in Canberra where we talked about this. So there is no, we didn't know this. We didn't know this. They all know who I am. They all know my view. I had many conversations with many people, and one MP said was that the establishment, whether it's the PM or the RBA or Treasury, they know that things are stuffed. This was about a year and a half ago, and they're looking for plausible deniability. I always thought that plausible deniability would come in the form of a bank falling over, like a Deutsche Bank or a foreign bank. But no one's. I didn't say a pandemic. And obviously, I think I think we said this in the last show. The Prime Minister has been saying, who could foresee, this coronavirus that's happening? But I just want to put this graph on the screen. So what I did last night was I actually, with my spreadsheet, I actually backdated it all the way back to September just to show what has happened with this repo market. So, it started in September, and we were almost at zero, the amount of liquidity thrown into this repo market, and where we are now is more than $750 billion. So this crisis happened well before the coronavirus. It's been a trend for 6 months. All that the coronavirus has done is speed up the process. And it's not just the coronavirus. It is early this week, this dispute between Russia and Saudi Arabia on oil production that led to a crash in the oil market, and then that obviously had its own ripple effects in the financial system. So, one of the things that we've discussed on multiple occasions, Martin, is what I didn't want to happen is that the elites in this country, so let's be specific, the politicians, the RBA leadership, governor, deputy governor, Lowe and Dobell, in particular, APRA, commercial bank CEOs, etc. I didn't want them to get away with blowing up. So the blowing up the debt bubble is a crime against the Australian people, in my view, and I didn't want them to escape accountability for this gross mismanagement of the economy for a couple of decades, particularly since the GFC. And what I'm afraid, Martin, is that I think the coronavirus is going to convince enough Australians that things were okay before the virus, and the virus is the plausible excuse as to why the economy is going to, go through a potential, well, not only just a potential, it is going to go through, a significant financial hardship, and people will suffer, whether the market crashes and the banks go under and it's a depression, or whether they keep on printing to infinity. There will be hardship. That's what Armageddon's all about. There's different types of hardships as to whether it's inflation or deflation. But I thought it was important, particularly this is kind of what I wanted to do these shows, was to provide a series of time points where you and I are on camera saying this is coming. So when they say, well, we didn't see it, well, they could not deny that they couldn't deny that it was coming. And yet now they're all going to say, well, because if I went back with Switzer and Joy, they're going to say, well, you didn't predict predict a pandemic. You didn't say there was going to be a virus that led to a financial crisis. What I knew was a debt bubble was going to blow up in one form or another. We just needed a match. Now, the match isn't the virus. The match is the 17th of September. But I think too many Australians are going to fall for the mainstream narrative, and that means, unfortunately, I think that our elites are going to get away with the crime of the decade, if not the century.
Yeah, I was going to say the century, and the point there is that we know last September is when the thing started, right? Well before any viruses, right?
That's right.
It was already falling apart, and all the virus has done is essentially laid bare the financial stresses and strains that exist, and probably have accelerated the process. It's a bit like a catalyst, but it hasn't fundamentally changed the trajectory which we were already on.
Correct.
Yep.
Correct. But too many Australians. Hopefully our viewers who watch the show will know that message, but I think too many Australians won't get that message, and that's why our elites are going to get away with it. And so we'll probably say a little bit more about that moving forward. But the other obviously important point is, and let's put this on the screen, is so in the last show we talked about the balance sheet of the US Federal Reserve. So again, 800 billion to 4.5 trillion. They promised they could reverse it. They got down to 3.8, and so these numbers come out on a weekly basis. So I saw the numbers this morning. So these are for Wednesday US time, and the balance sheet is above $4.3 trillion. So I think we are rapidly going to get back to $4.5 trillion. We're going to smash through that previous peak. And again, they always said that this was always temporary. It was reversible. There were skeptics who said that no, this is like what happens in the Banana Republic, where you print your currency to oblivion and you just expand your balance sheet to uncontrollable proportions. Well, this is where it looks like the Americans are taking the balance sheet of their central bank.
Yeah, and it has to be said, I think, John, that just dropping the rates like the Fed did by 50 basis points and then throwing all this money at it, they're burning all of the ammunition that they've got right way too soon, because I think this coronavirus thing is going to play out over the long term through the recession, right? So they're actually using the ammunition they've got for the wrong purposes.
Indeed. Now, where I just want to sort of finish the show is a couple of points, Martin. First one is a few people on Twitter today said, what other option does the government have? Now, here is the end game in terms of public policy, in terms of macroeconomic policy. You and I and Sean Quinn had a conversation back in September, and at some point we'll replay that for the audience. And we said that based on the experience of Ireland bailing out the banks, that is not good public policy in the long term, and we would let the system go. Well, I in particular said I would let the system go, have a depression, and then actually try to re-establish the economy on a more sound footing. And obviously, Professor Steve Keen said that household debt needs to reduce by 2/3 in order to have a healthy economy. And you yourself, when I put it to you, you said we need to alt control delete, and we need to start again. Yep. So we said massive social cost, suicide, drug abuse, homelessness. We know, we're not pussyfooting around. We know what that actually means, but that is in the long-term health of the economy. So, but the alternative is that you bail out the system. And again, just looking at the 8.8 billion, where did the RBA come from? They're printing it, and printing money, that does come at a cost. And so I talked about this with Robbie Barwick on the CEC report last April, and I thought I summarised it quite well. So let's actually play that for the audience. Now, we have a massive amount of foreign debt. A lot of that foreign debt is particularly the short-term foreign debt. It's tied in the banks that have gone into the households. So the establishment doesn't want the housing market to collapse, because they'll be blamed for it because they blew up the bubble in the first place. So my big concern is that they are going to effectively sacrifice the dollar. So if unemployment...
And what form will that take? Just elaborate on what it means.
So the form it will take is, if unemployment goes up, if you start to see an increase in arrears and defaults, if the banks start to look shaky, they will lower interest rates, I think, to zero, potentially. They will do quantitative easing. They will get the new... what I think will be the Shorten government to start spending big in Canberra to prop the market up. And all of these things do not bode well for the value of the Australian dollar. It doesn't bode well for the serviceability of the foreign debt. And if we get to a point in which confidence in our ability to service our foreign debt, and just for the audience, we have $2.2 trillion of gross foreign debt. So, net is like 1.08 trillion. It is a record in the amount of foreign debt we have. If there is just a smidgen of doubt among foreign investors as to our ability to service this debt, the dollar will crash. And my big concern is there's not a voice in Parliament who is expressing concern about the dollar, concern about that all of these suggested policies around quantitative easing, zero interest rates, negative interest rates, and more spending, but also loose bank standards. What this could potentially do to the foreign debt, and then in terms of dollar. So this is where, just to highlight this point, this is where in the debate I kept on saying, the policy prescription that the Australian Financial Review and Christopher Joy and others are saying, these are things we will do to stabilise the housing market, it comes at a cost.
Yeah.
And my big concern is no one in the public sphere, but also in Parliament, is actually telling the public there's a cost and what are the consequences of this particular course of action.
Well, yeah, that's pretty clear, John.
Yeah. So the key issue is that there is a cost to fiscal stimulus. There is a cost to monetary stimulus. That cost has not been explained to the Australian people because every person in power, whether it's in the press, like the AFR, whether it's the banks, whether it's the RBA, whether it's Treasury, whether it's APRA, or the Prime Minister, they all have an interest to save this debt bubble. And what it ultimately means is it's going to lead to a currency crisis because we did a show, our third show, which is I think it's the most important show we ever did, where we explain when you have a currency that's unbacked, a fiat currency, we have seen more than 3,800 examples in the last 1,000 years. When a government, when bureaucrats print too much of it, it leads to currency failure, and that's where that's where the world is headed to, because everyone's doing this. But in Australia's case, the Australian dollar is going to be smashed in terms of its purchasing power, and that will manifest itself in all sorts of inflationary problems going forward. And if the government wants to do that, it's important that the government actually tells the people this is what we're doing, and explain to people what are the consequences. And yet the public have no idea. All the public knows is they've had huge cost of living problems for the last few years, and obviously your mortgage stress and some of the other indexes you do with DFA, they all play that out, and people don't understand why. I mean, I had a conversation with someone who's who's a sophisticated investor, and he kept on saying to me, inflation is low because the government says it's so. So we're going to talk about these CPI numbers going forward, but no, there is an inflation problem today. That inflation problem is going to get worse. The currency is going to be in a lot of trouble, and no one in Australia has actually explained, what is the consequences of all of this stimulus madness.
Yeah, unfortunately, you're right, John, and we're going to find out the hard way, aren't we?
Yes. We're going to find out the hard way because I don't think there's a genuine discussion among the masses. I mean, we have a reasonably good audience on this channel, but when you think of 25 million people, have millions of people actually been told of what happens when you print too much of a currency? No. All you get is a Reserve Bank with no public statements, no accountability with Parliament. They just basically click a button and they just created $8.8 billion out of nothing, and they just bailed out. I mean, because when they give it to the banks, well, what is that? That's effectively a bailout of the banks, because if they didn't, the banks could potentially could collapse. When we talk about bailout, bail-in, or bailout is when there is an external injection of funds into the banks. That's what happened today, an $8.8 billion bailout of the banks, and no doubt that if the stresses in the Australian banks get worse, that number will intensify and get larger.
And I'm thinking, we spoke to Harry Dent, do you remember, just over a year ago? And he basically said he thought that people would stand up and rebel when effectively the central banks did it again.
Indeed. So Harry Dent, so this is, I think, in 2018 when he was in Sydney and we had a conversation on camera.
Yep.
Harry Dent's thesis on why we would have a depression, he said that, after the GFC, the US Federal Reserve printed about $16 trillion to bail out the global financial system. He said that the next time around, it could be $50 trillion to $100 trillion. And he said there would be people who will stand up against the central banks. And because that level of money won't be printed and injected, there won't be enough liquidity to keep the banks open, and that's why we'll have the biggest depression in world history. So that's Harry's position. Now, theoretically, that is still possible, but the key issue is that the central banks are printing. Look, we're now talking billions, but soon it's going to be trillions, and millions of people around the world, if not billions, have no idea what the central banks are doing. Why? Because the press are not actually explaining to people what that about this money printing and what it actually means.
Yeah, and my bottom line is this: the interests of the people are not being served by what the central banks are doing.
No.
Right? They're protecting the elite, they're protecting the banking system, but it's everyday Australians and other people around the world who are getting crushed in the process.
Absolutely.
And that's why, in the interest of people, is so important.
Absolutely.
Martin North, John Adams, in the interest of people. We'll see you again next time.